Hello my dear friends and welcome to StudyIQ. Welcome to the series of Indian economy related current affairs exclusively for your UPSC Preliminary Examination 2009. So this is a series of videos where we will cover the entire current affairs for Indian economy from the prelims point of view for the last 1 year. And this series would contain a total of 10 videos and this is your 5th video. So this is the lecture number 5 in this series. We have already covered 4 lectures and the first 3 lectures were on banking and financial sector and the 4th lecture was the external sector part 1. So this is going to be the part 2 of the external sector for your preliminary examination. Those who have missed the previous videos, you can find the video on our StudyIQ channel. These series of videos will help you to score better marks in your UPSC preliminary examination, as we will cover the entire current affairs in the past 1 year from your exam perspective. So we will be covering 100 plus important topics for your preliminary examination. So welcome to StudyIQ and let us start. But before that, this is our channel StudyIQ and we are providing pen drive courses for various competitive examinations including SSC and bank courses, UPSC optionals, SSC JEE courses, teaching examination, railway examination, defense examination, RBI grade B, NABARD grade A, UGC NET, UPSC Civil Services Examination, CLAT exams for various state PSCs and also for various professional courses. You can visit our website www.studyiq.com for more details, or you can call to any of these numbers for more information. So let us start. So as I said in the beginning, this is the second part of the external sector video. So we have already covered a few important topics in the external sector. The rest of the topics we'll cover in this lecture. So this is going to be the last lecture on the external sector module. And from the next lecture, we will move on to the next module. So we will start with inverted duty structure. Let us understand what is inverted duty structure. So an inverted duty structure or an IDS means a higher duty on intermediate as opposed to final goods or finished goods. So here the idea or logic is very simple. Under inverted duty structure, the duty structure is inverted. So there are both final goods and intermediate goods. Under inverted duty structure, the intermediate goods or the raw materials are charged with higher duties. So the raw materials or the intermediate goods will attract more duty compared to the final goods. So comparatively, the final or the finished goods have lesser duty compared to intermediate goods. So we can say that inverted duty structure is a situation where the import duty on finished goods is lower compared to the import duty on raw materials. And these raw materials are used in the production of the finished goods. Now for example, suppose the tariff or the import tax on the import of tires is 10%, but the natural rubber will attract an import duty of 20%. So here natural rubber is the intermediate good or the raw material, but the tire is a finished good. So in this example, the intermediate good has more import duty compared to the finished good. So this is called inverted duty structure. Now let us understand what are the concerns or difficulties associated with inverted duty structure. First of all, when the import duty on raw materials is high, it is very difficult to produce the finished goods. So the domestic industries cannot produce the finished goods at a competitive price. So it will hamper the domestic industries in the production of final goods. And several industries are dependent on imported raw materials. So these industries will be in difficulty when there is an inverted duty structure. And high tax on the raw materials means that it will increase the price, leading to inflation. And in this scenario, the foreign goods would be coming at a lower price. That means that the foreign goods or the finished goods have lesser tax burden. So this means that the domestic industries that are dependent on the raw materials will be in difficulty, but the finished good that enters the Indian market from other countries will attract only lesser taxes and therefore they will have a tax advantage. So it will hamper the domestic industries. So we can say that inverted duty structure is uncompetitive against the imported finished goods and therefore it will hamper the domestic industry. So it will discourage the domestic value addition. So this is briefly about inverted duty structure. Moving on to the next topic, Enforcement Directorate. The Enforcement Directorate is a law enforcement agency and it is an economic intelligence agency that is responsible for enforcing the economic laws and fighting economic crime in India. So any economy related crime, any finance related crime in India is dealt by the Enforcement Directorate. So it is basically a law enforcement agency and an economic intelligence agency, and it comes under the Department of Revenue, Ministry of Finance. So do not confuse it with Ministry of Home Affairs, because Enforcement Directorate is a law enforcement agency and economic intelligence unit, and it enforces economic laws and fighting for economic crimes in India. So therefore it comes under the Ministry of Finance, not under the Ministry of Home Affairs. So please do not make a confusion between both this. Now coming to the objectives of the Enforcement Directorate, the prime objective of Enforcement Directorate is the enforcement of two key acts. The first one is FEMA, that is Foreign Exchange Management Act of 1999, and the second one is Prevention of Money Laundering Act of 2002. So PMLA, Prevention of Money Laundering Act 2002, and FEMA 1999. These are the two acts for which the Enforcement Directorate is responsible for the enforcement. Now coming to the composition of the Enforcement Directorate, it comprises of officers of Indian Revenue Service, that is IRS officers, plus IPS officers, Indian Police Service and Indian Administrative Service. So it comprises of officers from IRS, IPS and IAS. So IPS and IAS, they are All India Services, and comprises also of officers from IRS or Revenue Service. And if we look at the origin of Enforcement Directorate, it was established on 1st of May 1956, and originally this was known as Enforcement Unit, and later in 1957 the name was changed to Enforcement Directorate. So this is briefly about Enforcement Directorate. Now let us understand letters of understanding. So basically letters of understanding are a bank guarantee, or they are a letter of guarantee under which a particular bank allows its customers to raise money from another Indian bank's foreign branch in the form of short-term credit. So technically letter of credit is a bank guarantee, and under this bank guarantee a particular bank will allow its customer to raise some money from another Indian bank's foreign branch, and this will be in the form of short-term credit, and the loan amount is used to make payment to the customer's offshore suppliers in foreign currency. So this short-term credit will be used in order to make payment to the customers' offshore supplies in foreign currency, and the overseas bank usually lends to the importer based on LOU issued by the importer's bank. So basically LOU or letter of understanding is a very important instrument in order to facilitate import trade. So the significance of LOU is that an importer in India, they cannot simply buy dollars and send it abroad to make the payments to his supplier. So instruments like LOU, letters of credit, etc. are required to carry out such transactions. And LOUs, they are essentially a form of guarantee. And why it is more important is because it is more cheaper and it is also more convenient way for importers to raise credit. So this is briefly about letters of understanding. Now the next topic is Directorate General of Trade Remedies. Why it has become an important current affair? It is because a unified Director General of Trade Remedies was formed, and the objective was to provide comprehensive and swift trade defense mechanism in India. So the Directorate General of Trade Remedies was formed by subsuming the Directorate General of Anti-Dumping and Allied Duties, Directorate General of Safeguards, and some functions of the Directorate General of Foreign Trade. So all three of this were subsumed, or some functions of Directorate General of Foreign Trade and Anti-Dumping and Allied Services and Directorate General of Safeguards were subsumed in order to form the Directorate General of Trade Remedies. And Directorate General of Trade Remedies will be now the apex national authority for all the trade remedial measures. And the trade remedial measures includes anti-dumping, countervailing, safeguard measures, etc. And the office of the Directorate General of Trade Remedies will be an attached office to the Department of Commerce. Now in this context, we should understand what are the trade remedial measures. Some of the important trade remedial measures we will discuss here, very important for your preliminary examination. So the first trade remedial measure is anti-dumping duties. So what is meant by an anti-dumping duty? So anti-dumping duties, they are special duties imposed when a firm sells a product to the importing market at a price that is lower than the price charged in the home market or below the cost of production. So this question was asked once in UPSC preliminary examination. So very important. So we can say that special duty charged by an importer country. Let us take the example of India and China. Suppose India is the importer and China is the exporter. Now India can charge anti-dumping duty on Chinese goods when China sells the product to India at a price that is lower than the price available in Chinese market, or when the cost of production is higher than the price at which the commodities are sold. So dumping means exporting huge quantities of a particular commodity to other market. So in case of China, we have several times adopted the anti-dumping duties. And why is anti-dumping duties important is because under dumping, usually a country will sell a product at a very cheaper price, and this will hamper the domestic industries. The domestic industries will lose the market because foreign goods are available at much cheaper price. So this is the anti-dumping duty, and it is a very important safeguard adopted by the country for dumping activities. Second one is countervailing duty. Now what is meant by a countervailing duty? A countervailing duty is imposed if the exporting nation is found to offer export subsidies to the exporters. Let us again take the example of China and India. China being the exporter and India being the importer. Here China is providing subsidies to the exporters from China in order to promote exports. So if such type of subsidies are provided by the exporting country, the importing country can charge countervailing duty, which is also called CVD. So once CVD or countervailing duty is charged, this will compensate for the subsidies provided by the exporting country. So this is also a measure to protect the domestic producers and the domestic suppliers. Now the third one is safeguard duty. So safeguard duty, it is temporary in nature and it is imposed when the imports of a product due to tariff concessions or other WTO obligations increase unexpectedly. Suppose due to WTO obligations or any tariff concessions, when a particular commodity enters the market at large quantities at cheaper prices, the government can impose safeguard duty, and it is only a temporary measure, and this is also used in order to save the domestic producers. So the safeguard duty was used many times recently by the Indian government on foreign goods. So it is a very important safeguard mechanism. So all these three are very important. First one, anti-dumping duty. Second, countervailing duty. Third one, safeguard duty. So these are very important, and this can be asked in your examination, because once UPSC has asked a question on what is anti-dumping duty, 4 statements were given and you had to pick the right statement. So you should know what it is, what context it is used, and what is the objective of such mechanisms. Now the next topic is Exim Bank or Export-Import Bank of India. Very important topic for your preliminary examination. So now first coming to the current affair. The central government had approved a capital infusion of rupees 6,000 crore in the Export-Import Bank of India or the Exim Bank of India through recapitalization bonds. So we will see what is Exim Bank, what is the purpose of Exim Bank. The Export-Import Bank or the Exim Bank was established in 1982 through an act under the Act of the Parliament, and it is the apex financial institution for financing, facilitating and promoting India's international trade. So what is more important to be remembered here is that it is the apex financial institution that facilitates international trade in India, and Exim Bank is regulated by RBI. So it comes under the regulatory mechanism of RBI or the Reserve Bank of India, which is the apex monetary institution in the country. Now the functions of Exim Bank. The bank primarily lends to exports from India. So the main purpose is to support the exporters by financing them, and it provides capital or lending facilities to exporters from India, including supporting overseas buyers and Indian suppliers for export of developmental and infrastructure projects, equipment, goods and services from India. So it does not only cover goods and services, it also covers developmental projects, infrastructural projects, equipments, etc. Now let us understand what is concessional finance mechanism under Exim Bank. CFS or concessional finance mechanism. So under the Exim Bank, the bank would support Indian entities bidding for strategically important infrastructure projects abroad. And under the CFS scheme, the Ministry of External Affairs selects the project keeping in view strategic interest. So what you should remember about CFS or concessional finance scheme is that this is a payment mechanism or a lending mechanism for strategically important projects abroad, and because of the strategic importance, it has been selected by the Ministry of External Affairs. So the project selection is done by the Ministry of External Affairs. Now the second important scheme of Exim Bank is the GRID. GRID stands for Grassroots Initiative and Development. So GRID is Grassroots Initiative and Development, and Exim Banks under the GRID provides financial support to promote grassroots initiatives or technologies, particularly the ones with export potential. For example, it helps artisans, producer groups, clusters, small enterprises, NGOs, etc. Those who have high potential for exports to realize remunerative return on their produce and to facilitate exports from these units. That is GRID. It is also very important. Now third one is recapitalization bonds. Let us understand what is recapitalization bonds. This is important because recently the central government approved capital infusion of 6,000 crore into Exim Bank of India through recapitalization bonds. So in this context, let us understand what is meant by recapitalization. So a government bond is an instrument to raise money from the market with a promise to repay the face value at the maturity. So it means that these bonds are issued at discount. Suppose the face value of the bonds are rupees 100. This will be issued at a discount of rupees 9. So at maturity, the face value of rupees 100 would be provided to the borrower of the bond, and it also provides a periodic interest. So a bond issued for the purpose of recapitalization is called recapitalization bonds. A recapitalization means providing extra capital. Now let us understand how does the recapitalization bonds work. The government will issue recapitalization bonds which banks will subscribe and enter it as an investment in their books. So government will issue recapitalization bonds, and the commercial banks, the scheduled commercial banks will subscribe to the bonds and they will show it as an investment in their books. And the banks will lend money to the government for subscribing the bonds. And now the money that is raised by the government through these bonds will go back to the banks as the capital. And this will strengthen the balance sheet of the bank, showing this money as capital adequacy. So recapitalization is very important because the government had recently recapitalized many other commercial banks also. So it's a very important concept. So you should understand here that the government issues the bonds and the banks will subscribe to the bonds and enter it as an investment in their books, and the banks will lend the money to the government for subscribing the bonds, and in return the government will give the money back to the banks, and this is done to strengthen the balance sheet of the banks. So these are the important concepts related to Exim Bank of India. Now moving on to the next concept, we will understand what is meant by an Export Credit Guarantee Corporation. Now first, coming to the current affairs. The Cabinet Committee on Economic Affairs. Cabinet Committee on Economic Affairs is chaired by the Prime Minister, has approved capital infusion of 2,000 crore for strengthening the Export Credit Guarantee Corporation. So here also capital infusion has taken place. So in this context, we will understand what is Export Credit Guarantee Corporation. So Export Credit Guarantee Corporation is a company that is fully owned by Government of India. So it is a Government of India owned company. It is wholly or fully owned by Government of India, and it provides export credit insurance support to Indian exporters. So the purpose is to provide export credit insurance support, and it is controlled by the Ministry of Commerce. The Export Credit Guarantee Corporation is under the Ministry of Commerce, And the functions includes providing credit risk insurance. It also offers guarantees to banks and financial institutions. And it also provides overseas investment insurance. So this is about Export Credit Guarantee Corporation. Now moving on to the next topic, that is World Customs Organization. So what is World Customs Organization? World Customs Organization was established in 1952 as the Customs Cooperation Council. So it is an independent intergovernmental body. It is intergovernmental body, and the purpose is to enhance the effectiveness and efficiency of customs administration. And the significance is that it is the only global organization which defines global standards and procedures for customs clearances. So it is a global organization and the only global organization which sets standards for customs implementation. And India is also a member of the World Customs Organization. India joined World Customs Organization in 1971. And in July 2018, India became the vice chair or the regional head for the Asia Pacific region of World Customs Organization, and that is why it has become a very important topic for us. And also recently the 80th session of the Policy Commission meeting of World Customs Organization was held in India. So because of these two important current facts, that is India hosted the 80th session, and also in 2018 India became the vice chair or the regional head of the Asia Pacific region for the WCO or the World Customs Organization. For 2 years India is the vice chair or the regional head. So because of these factors it has become an important current affair. So it's very important from your examination point of view. Now these are the topics under the external sector of Indian economy which are very relevant for your upcoming UPSC preliminary examination. I have tried to cover all the important topics that have come in the current affairs for the past 1 year under external sector. I think this would be enough for your Indian economy external sector for your preliminary examination. And from the next lecture we will start the third module. So as of now we have completed total 5 lectures and 2 modules. The first module is banking and finance module. Second module is external sector module. So we have completed 2 modules, remaining 3 more modules and 5 more lectures. And those who have missed the previous videos, you can find the previous videos on the StudyIQ channel. Please watch those videos also. Thank you. You can find the PDF of this lecture on my Facebook page. You can also follow my Facebook page for more video updates, and please write to me at joyce.studyiq@gmail.com for any of your queries or clarifications. Thank you.